You all come in, come in. Let me give me a sound check. I changed microphones this week because this microphone stand holder is not leaning. But I am so excited for this live stream because I get to pull out the whiteboard. You all just don't know how much I love to teach this. I taught this so much when I was doing credit repair, and I have to make sure that my get the dust off of my marker, my dry erase marker. You just don't know how much I love to teach. So let me know if this microphone, if you can hear the sound, because I do not want to be talking. For the people that's coming in, make sure you hit that thumbs up. I even put on, this is the retro shirt, right? I put the queen, look at that. I put my queen of credit shirt on. I'm like, all you all had to do was ask. As the good book says, the number one best-selling book of all time says, ask and it shall be given. Someone left me a message and said, Queen, can you teach us how to pay off our mortgage in 5 to 7 years? Now, it's been some time. It's been some time. I'm going to see if I still got it because I don't know. Yeah, loud and clear. Thank you. Oh, you spell your name just like my first name. See? Well, part of my first name is Love. It's pronounced Tanya, Tanya. Even though, let me tell you this story real quick. I used to spell it with an O because I got tired of people pronouncing it as Tanya when I spelled it with an A. And, back in the day in elementary school, we used to have to take our work home, class work home that was graded, and our parents would sign off on it. And I took it to my mother one day, and she said, "Why you spell your name with the O?" And I said, "Well, Mom, everybody, when I spell it with the all A's, everybody call me Tanya. So I want them to know it's Tanya." She said, "Well, you just tell them it's Tanya. That's not the way I spelled your name. You spelled your name the way I, I spelled it." I was like, "Yes, ma'am." She didn't have to worry about me spelling it with an O again. So if they say Latanya, I just said, no, it's Tanya. But listen, hello, Tanya, to you as well. Hello to you as well. And oh, I am so excited. How to pay off your mortgage in 5 to 7 years. I'm telling you all right now, if you have never, or this is like something that you haven't listened to in some time, or if you've never heard this information that I'm about to give you right now is going to literally shock you. I mean, this is going to be shocking and breathtaking. And I really love teaching this to high school students, college students, um, newlyweds, because they can get ahead of the game way earlier than I did. I didn't take a course like this when I purchased my home. I didn't know anything about this. All I wanted when I purchased my home, and at the time I was married, all I wanted was low interest rate. Can some of you all relate to that? What's the interest rate, right? And what's my monthly payment? That's all that concerned me. What is my interest rate and what is my monthly payments? Can we be able to afford it? And I thought at that time, if I got locked in, which I did, at a 2% or 3% interest rate, that was just heaven. That was just a miracle. That's a blessing. I'm thinking they practically giving me this house away, right? So I purchased my first home right after the recession in 2008, when the prices of homes, well, my only home, I'm saying my first home, my only house, because I still have it. And when the prices of homes, I felt like was at an all-time low. Again, I was married at the time, so my ex-husband and I, we purchased this home, and we had immediate equity in the house, right? We were so excited. I'm still excited. Had immediate equity in the house. Now, what I did not know at that time was that we had an FHA loan, or have, right? Still on here. And with the FHA loan, I can't attest to any other loan. But what had to come with that was called a PMI, a private mortgage insurance, right? So we have escrow, we have PMI, we have private mortgage insurance, but it was still at a monthly affordable payment. And so it wasn't until one day I just sat down and I did the math and I said, wait a minute. If we pay this as scheduled, even if I get it refinanced, which is what a lot of people do, for 15 years, this is going to be so much interest added into this loan. I'm like, this is not right. So, even did you all know this, for example? And I want you to participate with me because I'm so excited about this live stream because it's been years since I taught this. Did you all know, for example, that only 1% of Americans pay off their mortgage? Does not matter if it's a 15-year or 30-year. I want you all to put yes or no in the comments. It does not matter if it's a 15-year or 30-year mortgage. Only 1% of home buyers actually pay the mortgage off. What they will do is either refinance or they'll sell that house and only to purchase another house, right? And I was having a conversation with my uncle right before I decided to do this live stream, and he and I were talking about that even in today's market of home buying, people will sell a home, that may be at 300,000 or sell it for 350,000. They have built-in equity only to purchase another home that may cost 600,000. And a house that does not pay you is a liability, is not an asset, right? An asset, if you are a landlord, an asset is when someone is paying you to live in real estate property, not you paying the banks. And so a house is an asset to the banks. Now I'm saying 25 people in here, and unless you're driving and your hands are free, I want you all to come in and engage in this teaching and make a mind message connection so it can stick with you mentally, right? If your hands are free, I want you to engage because the more you are engaged, the more information you will retain. Come on now, the teacher in me is coming out. So let's break this down. Only 1% of home buyers pay off their mortgage, and the banks know this. And again, hit that like button, share this information because this information not only you need it, but your friends and your family members need it as well. If you have some young adults, people just get married, they're renting out of high school, maybe in college, please share this video with them. So let's break down exactly what the word mortgage means initially, right? So let me stand up. I may have to stand up and get out of this chair. So let me know if my sound is ever too far out of reach, right? So now just the word mortgage within itself, MORT, it means dead. Dead. It means a death pledge, right? So, all right, we got dead, and I know you can't see my hand right that well. And engage means a grip or pledge. So, can I move this a little close? So, we have mortgage, which means dead, and we have gauge, which means a grip or pledge. So, why would they name this mortgage? Why would they name this as a death pledge until you pay it off, a grip on a death pledge until you pay it off? So, you are under technically a death pledge until this is paid off. Now, this is the information that people need to know. Whenever you have a mortgage, the interest rate is different than any other loan, right? In a mortgage, for example, you have what's called an amortization interest rate, right? So make sure I spelled it correctly because again, I haven't taught this in years. And then I'm a former basketball coach. I'm not used to writing that much anyway. I'm used to drawing X's and O's and lines. So when you have a home, it's called amortization interest. Now, as you can tell, I was not an art teacher in school, right? I'm not an art teacher. And then, but it's different. If you have a credit card, the interest is simple interest, and it's also called revolving credit, right? So let's say you have a credit card. That's your numbers, that's your Visa. The interest card on a credit card is simple yet revolving. Now, with this amortization interest, it compounds, right? It compounds. So let's put that whiteboard teaching. You got to love it. Amortization interest that compounds. Even if you have a vehicle, right? We just gonna we just gonna draw you a little SUV. This is called an installment loan. Oh, I love teaching about credit, right? This is called installment loan with the vehicle. Credit card, lines of credit is called revolving. Why is that? Well, you ice 300 people in. Come on, you all hit the thumbs up. If we have this many people in, it's definitely should be more people in the comment section unless I have 300, 298 people that travel. But so you all hit the thumbs up. Come on now. I'm excited about this. This is perfect quest. And so participate and hit the thumbs up, right? Even if you're watching this on the replay. So it's called revolving interest because it's a line of credit on your credit card, right? And so that means it revolves. So every time that you make a payment to pay down your credit card, the amount that you can use or borrow again revolves. Unlike an amortization loan from a house or an installment loan from a vehicle, once you pay it, you can't borrow back from it. In fact, let me give you a credit list. If you pay down your revolving debt first, your lines of credit on the credit card, that will increase your credit score. It will increase your credit score more than paying off your home or vehicle debt. I won't say that it decreases it, but your credit score will pretty much remain the same. It won't have that impact on it. Why? Because they don't want to give you incentives credit wise to pay down a vehicle or a mortgage loan because they want them to stay with you the tenure of a loan. Let me show you, for example, how a vehicle loan is calculated, right? And then when I show you how a mortgage loan is calculated, again, you are going to be shocked. So let's say I know it's 2024 and you probably can't even find a vehicle for this price, but we're going to do it. Well, at least a brand new vehicle anyway, right? So let's say you found a vehicle for $20,000. Now you probably can't find this interest rate either, but it's very easy for me to add. And let's say you find a $20,000 vehicle at 3% interest rate. So once you do the calculation on a vehicle loan at 3% interest rate, that's $359.37. And this is over a 5 year time period. So 5 years equals 60 months. And with credit cards, right? Because I told you it's revolving credit. That means you can borrow over and over and over again, as long as you're paying good and good standing. Every time that you make a payment on a credit card and vehicle, because it's simple interest, the interest is not compounding, your interest next month will decrease, meaning it will go lower. So 359 is added into your monthly payment of interest for a vehicle, for example, at $20,000 at 3% interest rate over the 5 year term of the loan, right? So over the five year term of the loan. Now, that's not bad. That's not bad. I promise you, because I'm about to show you why a mortgage is called a death pledge or a death grip until it's paid off. And someone on my other live stream used the word usury, right? Use the word usury on my other live stream. And I was like, no, that's not usury. It's not usury to get these interest rate applied to you. Even with a credit card at 21% APR. And this is just a side note. You need to know whenever the statement date on your credit card is versus the due date. The statement date is the date that your credit card report your balance to the three credit agencies, Equifax, Experian, TransUnion. If you pay down that balance on the statement date versus the due date, and hopefully the statement dates are always before the due date, it will help your credit score because you're reporting at the lowest balance amount of the month because you're making a payment. So either you want to pay on the statement date or at least 2 to 3 days before the statement date. So your lowest balance is reporting, and that helps your credit score as well. Also, when it comes to your credit cards, it is in the best interest to keep the balance amount under 20%. You see, I'm pausing because I haven't talked this in a while. So let's say you have a $5,000 credit limit, or at least 30%, right? Right. But I'm going to say 20%. If you have a $5,000 credit limit, 20% of that is $1,000, which means you want to keep your balance at least $1,000. Now, 30% would be $1,500, right? Because the lower your balance, the higher that helps your credit score. But at anything, don't max it out. Don't max it out because maxing out credit cards and not paying them to get a very keep it at least 30%, like $1,500. Like, and then if it's a $10,000 credit limit, 30% would be $3,000 to keep your highest credit score and to just keep you from maxing out credit cards that will put you in years and years of payments back. Let me show you how this is so different from your mortgage. Now, for the people that's participating, if you want to add in, um, hold on, if you want to add in, that's the wrong page, your loan amount and tell me what your interest rate is, I can calculate the interest for you, or you can just go to this website. I can put in the link or in the comment section rather, and you can calculate it yourself. So we're looking at a $250,000 loan. I'm going to make it applicable to probably where interest rates were promoted about during 2019 and 2020, because there were so many people so excited about a 2% interest rate. But you could very seldom find a house for 250,000 for a 2% interest rate during that time of 2019 and 2020. So most people get a 30-year loan because they tell themselves that over time, hey, we're going to make extra payments towards his house to pay this loan off faster. But oftentimes it does not work that way. Now, at a 2% interest rate, $300,000 loan, what happens is, so you're at 5%. If you can tell me what's your loan amount, I can do the calculation for you. Are you telling me maybe I should put 5%? I'm going to put 2.5%. How about that? Let's say we had people with good credit. Look at the difference of the interest from a 0.50%. Now, you are gonna have to indulge me for a moment because I am a little rusty, but you really have more than just this interest that's built in. Again, I had PMI insurance that I had to pay for my home, and we can't forget property taxes that's included in the escrow. Now, if I'm missing anything, you all just let me know, right? So we're gonna look at 250,000. Everyone was getting 20, $30,000 more for their home. So at a 2.5% interest rate, if you found a deal for 300,000, your monthly payment, and this is without escrow or PMI included, was around the figure of $1,185. Look at the total interest paid, $126,731. So your total cost of that loan was $426,731. Let me change that because some people say, well, Queen, I'll just get a 15-year. Well, the interest is a little better. It's only 60,000, but your monthly payment has doubled to 2,000 a month. And then your total cost of the loan is 360,066. And this is why it's called compounding interest, because an amortization loan with a home, your interest is front loaded, right? Okay, let me look at this example. A 5% 30-year house was 159,000 and you owe, are you saying 159,000 and you owe now 109,000? If so, I'll do the numbers. I just want to make sure that I'm accurate. Now, this lets you know that interest rates are just interesting. Because if I told you that I will charge you 18% on $30,000, but you can pay it off in 18 months, which is 1.5 years, well, a year and a half, you said it that way, versus 2.5% on the same amount in 360 months, you will go for the 18 months payoff versus the 360-month payoff because you're paying back six figures back to the bank. But that's not the thing. I know you probably thought, Queen, that's enough for me to see. No, no, it's more to it. Remember when I told you that when you pay down your credit card debt and your vehicle debt, you're only charged on the balance owed every month? Because as your balance get lower and lower, your interest is then recalculated. They don't do that with a mortgage with a death pledge. Mm-mm. This $126,000 is front loaded. That means the monthly payment, this is without escrow or private mortgage insurance if you have to get it. That $181,185. Let me see if they got of your monthly payments. This is how your payments change over the life of the loan. When you start out making those payments, September, right, July, breaking it down of this month. This breaks down how the interest is calculated. So you start paying it, this is February. You pay $625 toward that interest out of the 1,100 and I think 84. Only $560, which is about 50-50 payment, is going towards your principal, which is the original amount that you borrow, which is the true amount. So your payment, and it's usually like an 80-20. This is being, very generous, I think. So your loan balance starts off in 2024, high, 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 high. And then it doesn't wait until you get almost to, we have this crossing in 2041. From 2041 to you kind of just even out until you're at that crossroads point. So we're talking, let's do the math on this 2041 year, 17 years, 15 years, half of the loan. And look at year 15, the interest paid on this 100,000, where out of the 300,000, you almost are just at 150K. You're almost at the point where you pay back half of what you borrowed because that's 147,000. You still, after 17 years, owe $152,000. Now let's look at a 15 year, same amount, 300,000, lower interest. You put your total cost of the loan is still 60,000. That's a 666 on that. But you paying $1,000 more. So even at midpoint of 2032, which is almost what 12 years difference, you still have half of the loan still due. Doesn't matter 15 year or 30. And you pay $46,000 in interest. And this is why credit card debt and vehicle debt is way better than a death pledge mortgage debt, right? That's way better than a mortgage debt. So then people ask me, how can I cut that interest? How can I not pay back for my home 2 or 3 times over? I'm glad you asked. Because when I saw this, when I started looking at my bank payments, and then don't forget, this does not include escrow or PMI. So there's additional hundreds of dollars is going to your taxes, property taxes, escrow, and it's going if you have to get private mortgage insurance. If you don't have the money at closing to, just pay for your PMI insurance up front, like I did when I first purchased this house. We didn't have the money to just pay it up front, so we got it calculated into our loan. But that was additional money that was not going towards the principal. So what velocity banking does, and Portia, you came in right on time. Velocity banking probably won't work now for 2024 like it used to some years ago. Now, when I found out about velocity banking, I implemented, right? But it probably won't be as effective. So what velocity banking is and what it does is when you can take a line of credit. I told you all about credit cards. These are my business partners, right? Credit cards are my business partners. But when you can take A line of credit, mainly a credit card. This was velocity banking. And this only works for people that have good credit and preferably a 0% interest rate offer for maybe a month to 12 months to 18 months, a year and a half or up to a year. Is if you have like a high credit limit credit card, 10,000, $20,000, you can make lump sum payments of $10,000 on your credit card. Now, this said, well, Queen, now I have $10,000 worth of credit card debt. Velocity banking only works with people that have positive cash flow. That's number one, and preferably good credit because you don't want to have a 17% interest rate paying back on your credit card. You would want a 0%. And what you would do, especially if you can get balance transfer checks to yourself and write those checks out, is that maybe you would send that payment in on your mortgage and say, hey, this is a $10,000 and it's called lump sum payment, right? Lump sum payment. So with that being said, let's say you have $500 positive cash flow after you paid all your bills, purchase your food, got the kids, whatever they need if you have children. At the end of the month, you average around an extra $500 that you can just play with if that's what you choose. Well, what you would do is a concept that's called paycheck parking. So you or your spouse or significant other will both take your paychecks, or if you're single, just your paycheck, and you would deposit it into your bank account. But when it came time for your credit card payment due, you would take that whole amount and pay it towards that credit card. Because remember, you just put $10,000 out to pay a lump sum to cut into the interest of that mortgage. And I wish I had, let me see if this calculator could show the effect of that. And it doesn't. See if I can find a velocity banking calculator. And so then you would pay as much as you can, all of your food, all of your groceries, right? Everything that you can get. You would use your credit card versus your debit card to purchase those things. Now, especially if your credit card had a reward incentive to it. But you get so many points a year or, for purchases towards certain things, or even cash back, because I used to tell people, to me, that's passive income. That's like writing a check to yourself that you can use your credit card like a debit card, and you don't get those benefits from using your debit card from a bank. The thing is, it requires a lot of discipline. It requires you not splurging out and taking those impromptu shopping sprees and going out to eat with friends and just splurging. And, it requires discipline. Now, you probably saying, well, Queen, okay, so now I'm making more purchase on my credit card and I've already put $10,000 on it. But remember, when you sent your entire paycheck towards that credit card, that counted as a payment. And over time, that $500 cash flow will over time pay down that credit card debt. And I used to give Excel spreadsheets so people can see the exact date that $10,000. You just rinse and repeat. Deposit your whole paycheck, make those purchases, everything on your credit card. In fact, when I used to teach this, it was this family of four. They had two children, a husband and a wife, and that credit card would accumulate so many awards points that they used to finance their full Disney World vacation every year. Money that they would have spent out of pocket anyway, but because they used their credit card like a debit card, they created memories, and it was really of no expense to them. But now in 2024, the velocity banking concept is just a little bit more harder because the government, the Fed, has raised interest rates. And it's not. There are some people that still have 0% interest rate on credit cards for balance transfers, right? But it's not a lot of people. And then you have people now because the increased prices of gas and groceries, they don't have surplus cash flow for that. But if you have surplus cash flow, I have two links in the description of this video, two videos I want you to watch. They're about 15 minutes long, and it will show you how to implement the velocity banking concept. If you qualify, if you have positive cash flow, if you have credit cards with very low interest, and if you're a disciplined person, then lump sum payments will work for you. When you deposit your whole paycheck towards the payment of that credit card, that's called, or that's what was called when I was teaching this, paycheck parking. And you put it on your statement date and it dropped that balance down. But remember, you're going to use it because you don't have any money in your bank account at this point. Now you may want to save a couple of $500 in there just for, something to lean back on. But you're using it for your everyday purchases as well. Now, I don't really teach that now. Actually, I hadn't taught this in a long time. So, what solution would I teach in 2024? Do you all want to know that? Yes or no? Come on, I'm showing up 200 people. Do you want to know that? Okay, that's good. 1.5% on every purchase. You have to like do your own math. Every purchase, 1.5%. Is it a reward system or is it cash back? How do they give that? I tell people cash back for using your credit card, like a debit card. To me, it's just passive income. But you have to be disciplined, right? Look like I'm getting the same people saying, come on. Okay, now you all see why I don't teach this, because some people don't be as excited as I do. They just don't. They don't be as excited as I do. So for 2024, but I'm going to teach it anyway. I'm going to teach it anyway. What strategy would I suggest if velocity banking is not an option for you? I'm glad you asked. Now, at the time when this house was first purchased, it was through JP Morgan and Chase. And JP Morgan and Chase did not allow me to make principal only payments, right? Like, I'm dropping thousands, five figures worth of game, and I can't get people to say yes. This is why I stopped doing credit repair because I was teaching credit in a way to get people assets, and all people wanted was liabilities. Queen, I want to buy this new house. I want to buy this new vehicle. They didn't have a mindset and they wanted it fast. I'm trying to buy this new house or this new vehicle and by next month. Can you do a credit sweep? Not knowing the ramifications of that, right? I'm like, credit repair is so low vibrational. It was at that time. I got out of it. Well, thank you so much, Queen Wisdom. I love you as well, right? All right, Miss Fulcher, cashback rewards. And so I had people I could fix their credit and they would buy houses and all that stuff and wouldn't even pay me right, I mean, it was just if people don't pay credit to us, some unfortunately they don't want to pay you for even helping them. And so I'm like, I'm through with this. I'm through with this. Let's see. Hi, Queen. I have used a strategy. You talked about rewards and cashback. I'm so happy for the info. Well, thank you. I appreciate you tuning in. Um, well, thank you. I appreciate it. I do it. Look at all the women in. Look at my women. Look at my queens up in here tonight. Should put Queen of Credit back on there instead of Crypto Queen, but you all know what I do. 2024 strategy. What would I do now if I had to start all over? Okay. Back to JP Morgan. They would not allow me to make biweekly payments and or to make principal only payments. Right. So what I would do right now, if you feel like you could not utilize or use the velocity banking concept or with credit card, but you have to be very, very disciplined. If I would call my mortgage And I'm so thankful that JP Morgan ended up selling my mortgage to another mortgage company. That now I can make payments at any time I get ready towards my principal and my escrow, right? And so making payments towards your principal will indirectly cut off your interest. So here's the mortgage repayment. And you all, I'm just telling you all, people charge people to give them the information that they know now. Like what I'm giving you tonight, people charge people for consultations for this. So at least share this video and hit the thumbs up. All right, so you have a 30-year mortgage per se. Let's say you're just getting started and you have 30 years remaining, you're just getting started. Now, our last example was 300K because it's hard to find 200K now because they just, so we're going to do 300K again. And our interest rate was at 2%, wasn't it? And let's just say your banker allowed you, right, to make just $100 extra payment towards your principal, and you have to tell them, or you have to know that it's going towards the principal. You see if it calculated. And so making an additional $100 towards your principal, which means that mortgage payoff results, your scheduled payment as is report is annual. Let me do it monthly. I don't think this calculator is calculating. Every time I hit it, it's not changing. Interest additional. Let me make sure that it's calculating. Give me a second. So let's say I did zero principal payments. It's showing the same thing. I don't know what's going on with this. Okay, let me just say it's 25 years remaining. Maybe that's better. I don't see it changing. Do you all? Let me see if I can find another calculator because I don't see the changing in this. So you can actually see the numbers, and it's too broad for me to just calculate in my head. Okay, I think I see what I did wrong. So let me show it again. Principal only payments, and I'm getting tired now, so I'm about to log off. Um, additional payment calculator. All right. So let's say you have a 30-year, 300,000. You're going to do just $100 more per month towards your principal. You have, let's say, 25 years left in the loan. Annual interest rate is it's just 2.5%. It's more realistic. Calculate and view report. I think that's what I was not doing correctly. Your original term is 30 years, 25 years remaining, 2.5% additional principal payments. Your normal payment would be 1,185. And again, this is without escrow or PMI, right? The accelerated payment now, because you're going to add an extra additional $100 towards your principal, is 1,285. Your total scheduled payment is a repayment back of 426,000. But just adding that extra $100 a month towards the principal is 400 total payments. It's 416,415. Look at right how much, and I need to let me add a sound effect because again I'm excited. I'm excited about teaching this. Right. Let me add a sound effect to this. Here we go. So can you hear it? Yep. You say $10,316. and your mortgage is short by 2 years and 7 months. Look at, oh, that's another, okay, okay, I didn't close it up. Your interest, because when you pay 1,185, $625 is going towards the interest if you do nothing. This is your existing payment schedule. But if you add $100 more towards the interest, you will see, or it says accelerated payment schedule. See if I can go over. I don't know why this is showing over here. But it's just supposed to, but at any rate, it's 2 years, 7 months paid off, right? Let's say that you have, let me stop sharing. An extra $200 you can free up. Maybe you paid off your PMI. Maybe you paid off some credit card debt and you increase your cash flow. Maybe you stop eating out. Maybe you stop getting the Louis Vuitton purses. You know, you found $200. You motivate yourself, and let's start it from day one, right? You're a first time home buyer. You're going to start this from day one, not year five. You found me and you found this information tonight before you purchased the house, right? You took the 30 years, you took the 2.5%, you have an extra 200 to apply towards the principal. Now, if you cannot pay towards the principal because not our mortgage would allow you, at least ask them, can you make biweekly payments? Because your interest is calculated by the day. So at least you can cut the amount of interest calculated on the principal amount every 7 to 14 days versus every 28 to 30 days. So $200 a month towards the interest. Your normal payment is 1,085. Now your payment is 1,385. Your scheduled payment, if you do nothing but pay it outright is 426,731. You add $200 to the principal, 399,000. I gotta do drum roll again. I'm not even gonna ask you all to cash out me. I'm just glad to teach you. Right? We gotta do that again. Let's do it. Boom. It is saving you 5 years, 11 months, saving you $27,383. What if you're trying to send your kids to college or whatever, right? 300, almost 30K in savings. Almost 30K in savings. So you are now when I tell you your mortgages is front loaded, they really are. Because as you can see, the existing payment and your accelerated is going to be about the same in the interest. But over time, you're saving years and you're saving thousands, five figures in interest. And you got all this for free from me. You got an hour of my time teaching you. You didn't even send a cash out. I didn't even tell you. Oh, my teeth are white. Oh, I just went to the dentist this week. I love when I get my teeth plucked because I look to smile, right? And so honestly, I'm logging off. But let me look at some of these questions. Is it true first 15 years of interest? I didn't do first 15 years. Let's look at 15 years. Let me redo this. But again, your payment doubles in 15 years. So I really did the amount of 30 year that most people get. Um, because most people opt out for the 15 years just because it makes their lower monthly payment more affordable. And you all let me know how my video is looking. I'm getting a weak Wi-Fi signal. I have been calling about my Wi-Fi. So I think it's just straight up. All right. So, well, thank you, Queen Wisdom. Queen Wisdom said, how can I send you a cash app? Thank you, love. Um, I definitely believe in reciprocity. And let's see. Just my cash app. This my cash app. LD Financial Coaching. So let's see. If you did a 15-year, 2.5%, 300,000 out of loan. Because again, you might find a house for 250K today, but that's probably unless we go through a housing market crash. That's realistically what we're gonna do. So calculate, report, and I'm going to give you out a link in the comment section too, where you can come in and do this yourself. This is the link to that. And again, in the description, I have two videos that if you want to do the velocity banking concept, I highly recommend you watch those videos. So this is the calculator link to their website. It's on bankrate.com. You can type in principal payments or mortgage calculator, right? So if you had a 15-year, 2.5%, I kept it at $200 a month towards the principal. The normal payment would be 2,000. Again, this is without escrow or PMI if you have to pay private mortgage insurance. Accelerate payment 2,200. Your total scheduled payment was 360,000. Now it would be 353,000. But this is at the beginning of the loan. I didn't do like 10 years, right? You'll save 6,792. You save almost 2 years from paying on that mortgage. So that's like 13 years. So that's a year and 7 months. So let me go back and show you all what it would look like with 5 years into your 15 year, and maybe you only have 10 years left, right? And 10 year, 300K loan, 2.5% interest. You paid what, 5 years as is before you watch this, and 2.5%. You have an extra $200 a month towards the principal. You have to tell them because they might put the money towards the interest. You have to pay it towards the principal, right? Now you're paying 2,200. The scheduled payment originally on 315, 2.5 is 360. It's the 66. Now it's 357. So really, I mean, it's your mortgage is only showing by a year according to this. Hold up. Yeah, I did 10 years. I guess it works more in the 30 year because the term of repaying is so much more longer. But you have 10 years left, 200 towards the principal. Um, you shave off a year, just a year, under a 15 year. Because remember, your 15 year, you're only paying back $60,066 in interest anyway versus a 30 year. So your interest was already lower. So you all, I'm logging off. I'm tired, but I thoroughly enjoyed this. But what I wanted to show people that your mortgage interest is not like a credit card or vehicle. It is front loaded. It's loaded from the get go with thousands, and usually 70 to 80% of your mortgage payment every month is only going towards escrow. If you have to have PMI insurance, and towards the interest because it's heavily front loaded. So if it's any such things as usury, this is definitely it. Because only 1% of people pay back their mortgages, right? Your debt pledge for life until you pay it off. And you're paying 3 times amount if you didn't come into the knowledge of this information. And this is information that I self sought my own. I didn't have a mentor or counselor to sit down and tell me this. My parents, I can tell my daughter this, but my parents didn't know this at the time. So I didn't have parents that could pass on generational knowledge to me. And in my opinion, generational knowledge is generational. And I used to coach some years ago, so if my basketball girls are still watching me, young ladies, when you get married or you get ready to buy a home, because you should be at least graduated college by now, right? When I coached them, they were high age teenagers. They should be young adults now. Please use this and understand this when buying a house. And again, if you're a mortgage like me, when I first started with JP Morgan and Chase, they had that group. They was like, no, we don't allow principal payments. then at least ask about the Bible. But if you can do the principal payments, that pays the original amount and gets it down and will save you thousand. And Miss Tanya, I love you too. I'm in California, so it's likely 250K. Oh, you in Cali, Cali. You need to invite me to a Lakers game, Tanya. That's my favorite team. Yeah, I grew up. I don't know if you're a sports fan, but I grew up on James Worthy, Magic Johnson, Byron Scott, Michael Cooper, Kareem Abdul-Jabbar. Right, I love the Lakers, and now it's LeBron, and I love Kobe and all that. So let me know what's going on in Cali. Let me see. What's my business now? There's something going on in Cali. Tanya, let me know. Let me see if I got my business number. I have text CC, but you don't have text CC. It's just my business number, 331-444-5556. Let me know what's going on in Cali. Right. And you stay safe out there. So much stuff going on in California, New York, as far as the economy is resolved. And royalty with a purpose. I just saw this. Thank you for tuning in. My first time seeing you. I have so many women on this live stream. So I'm so glad that you all are being the queens that you are and learning about your future financial goals. That's one of the disagreements I can tell you when I was married. My ex-husband and I were never on the same page. I mean, it was hard for us to just sit at a table and have a budget and finance meeting about where we want to go financially, what were the goals, what were we going to do financially, um, what credit card debts we was going to pay off. In fact, let me be transparent with you all because I have some women on. If I can find this text, I had someone to text me some weeks ago, and she showed me something I posted on YouTube years ago. This was when I was married, and you know how your text messages get deleted or pulled down. I'm not even sure. I tried to save it. I saved it somewhere. Let's see if it's under my favorites. And I told her, I said, oh, here it is. I said, thank you so much for reminding me of this text because I be so busy working. Sometimes I don't even stop and pause to see how far I came. Right. Yeah, escrow, PMI insurance. When I used to teach this, I see this statement. I'm not even sure if I saved it. Give me a couple minutes to look at it because I just came from the gym and I taught this and I was so excited. But you all, I am so tired. But I want to show you this as a motivation. And I would like every woman on this live stream to be married. It's just so expensive now to do it on your own. But if you're not married, if you've been through divorce or you just single, some stuff, been through some stuff like I have, and then until you get your help meet or whatever, just do the best, do what you can, or you had to get out of a situation or a relationship for whatever reason, do what you can. Or if you are married, you feel like, well, Queen, I don't have any financial help. I was like you, we could never come together. Well, do what you can do, right? And make moves. And I cannot find the index card. I do apologize. I thought I saved it in my favorites, but I guess it's just one of those things when you need it, you just cannot find it. Oh, I wish I can show you how much debt we were in because it was both our debts at the time, and that was stress for me. I don't know about everybody else, but debt is stress for me. It was stressful for me. Oh, I'm sorry. I cannot find it. I wish. I might have to text her and say, hey, can you send me that screenshot again? I want y'all to see my testimony. I'm going to look one more time, and show you that I've come a long, long way and that you all can too. This is already an hour long live stream, so I'm not going to prolong it. If I find it, I will post it on my YouTube channel somewhere where you all can see it. All right, Tanya. Why I call you Tanya? We just talked about it. It was Tanya. Okay, Tanya, you got me. Let me know what's going on in Cali. If you're anywhere near LA, because you just said California, it doesn't have to be LA, but just let me know. And you all have a state night. I pray that you implement this. Uh, Someone said, "Is Catherine love you, sister?" Well, I love you too. I'm getting so much digital love tonight. I used to say that all the time when I first started live streaming. Thank you for the digital love. So thank you for the digital love. I hope this helped. Oh, another thing, if you saying, Queen, I would love to put that into motion. I would love to apply that, but I don't have the cash flow right now. Go to my website, milliemoves.com. It has on there how to get an instant pay raise and increase your cash flow, especially if you are a where's that, employee. This was one of the strategies that I started implementing. Right, I found $500 when I got divorced. $500 they helped me was called income shifting to shift that money back to me because I didn't have a second job. I didn't have a pay raise. The money that I was already making, I used these strategies combined with credit and IRS experts when it came to taxes. And married couples that signed up for these services, they've saved like $1,100 between the both of them just from they were overpaying in taxes. Many people don't know how to fill out their W 2 accurately, or they don't know how to fill out their W 2 according to their dependents, or maybe no dependents that they have. And they're overpaying in their taxes in their paycheck. Now, you may ask me, well, Queen, if I get taxed less out of my paycheck, will I owe at tax season? No, you won't. It's called the strategy of adding a home based business to your paycheck. Even if you have a brick and mortar business, a business outside of your house, this is applicable because the home based business tax exemptions that you get are not the same as a traditional business. Like things that you're spending money on anyway, like this is square footage I write off in taxes because this is my office in my home. A portion of my utility bill. Um, I have two cell phones, my cell phone bills, my light, my water, my gas, my utilities. And before my daughter was at the age of 18, I had up to $12,000 tax exemption that I was able to utilize and write off for her from having this home based business because she worked in my home based business from home. And you get that, as a home based business owner. And it's all digital, just like you use Zoom, for digital things. It's nothing. You don't have to braid anyone's hairs or do anyone nails. Those are liabilities anyway, because when people come to your home and you're doing business in your home like that and they slip and fall or something on your concrete or your carpet, they can sue you. They can come after your personal assets. So this is the digital financial education home-based business. You work with experts. They make sure that you're not owing. In fact, some people even get a larger refund because as an employee, you only get tax deductions. You don't get tax exemptions. As a home-based business owner, now you get 475 tax exemptions. And so these are some strategies that I learned along the way that help me not only get out of debt, but be able to make principal payments. Because the reason why a lot of people don't make the principal payments is that uh, they live in, paycheck um, to paycheck. They got more month than money, right? So visit Millie Moves. I almost forgot to tell you all about that. Just to increase your cash flow, or even if you need credit repair services, visit their website. And I think my internet is getting weak for some reason. So I'm logging off, you all. Have a great remaining of your night or your evening, whatever part of the world. And if you're watching this on a replay, leave some digital love, leave some positive comments about how this video helped you. Okay, you all. As I always say, Queen out. Thank you all so much. I thoroughly enjoyed this live stream and my whiteboard teaching.